All right, ladies and gentlemen, I hope you had a wonderful weekend, and happy Father's Day to all of the fathers out there. I know we got a lot of Chad dads, and for real, man, if y'all have taken care of your kids, taken care of your family, provided, got them a long-term, and even just tried, baby, big shout out to you, man. I encourage y'all to keep it up. And everybody, you know, we got to appreciate the fathers more. You know, Mother's Day is the #2 holiday, I believe. But fathers, I know we got a lot of Chad dads. So go work, baby. And happy Father's Day. But now we got to talk about what we're getting into this week. We are coming off of Powell and the Fed and global politics. And then on Friday, I cleared out a good portion of my trading account. So we're going to talk about that. I'm probably going to even send people back to this video if they ever ask me, but we are getting into summer. There's a lot of things going on. I hope you're prepared for all of it. So let us not waste any time. I have that. I got the keys, the plays, all that good stuff. What I need from you, a thumbs up on the video. Make sure you're subscribed. And if you don't know, we are live Monday through Friday, 30 minutes before open, youtube.com/thestockmarket. We will see you there in the morning, baby. And before anything, don't forget, today is Sunday, Father's Day. Tomorrow is Monday. This is the random account generator. What we ask on this watch list is you post a option, keep it below $100, a random one that you like, post the strike price, expiration date, all that good stuff. Tomorrow morning, we're going to do a random comment picker and pick it. And since last time we got a debit spread, unfortunately, I'm pretty sure this account only has just buy options or sell options, so we keeping it straight up. So just post the play and let me know what you're thinking. But now, run it, baby.
Working to the couch, it's the 2020 election. Live in the hills, but still get a spread. Started with a live, but still reinvest it. Feel how I feel, then you feel it's a blessing. I just want the lesson, I just want protection. I'm up and I'm down, but they sound like progression. Farmer never plans if he waits for perfection. Finger to the down.
All right, off the bat, we got a pretty slow week ahead of us. And I say that because the market is closed on Wednesday, and we are not getting any big data, especially after the last 2 weeks. It was CPI, FOMC, the dot plot, the non-farms the week before that. In comparison, this week is not going to have as much. It'll be smaller data, but it still has some importance. We're going to be getting the retail sales, I believe, on Tuesday, and then towards the end of the week, we're going to get the PMI. And given how bonds moved, it will be important to watch. But like I'm saying, compared to everything we dealt with, it's not going to be that big. Now, the other factor, it's going to be the Fed speakers. Now, we just got the dot plot. A couple people moved. My theory out of all of what we got from Powell, he still wants to play the soft landing cut rates game, but at the same time, he is opening up his door for less hikes this year and pushing it to 2025. Now, if that's the case, or if we're going to get that hawkishness really feeding through from the dot plot, the Fed speakers this week, if they start talking, if it is a unanimous hawkish tone, maybe that'll add a speed bump. But also in the reverse, just like many times we've seen over this year, if you get the data, you get this reaction and all these things, and then the Fed speakers once again hold that bullishness, or every time they say rate cuts, the market is loving it, then it may be a pretty wild outcome in the sense that it's going to move very slow. So we're going to talk about that, but those are the two big things you got to watch for. The only other thing I would say keep an eye out for is the political trends. Last week, we had the French stuff at the beginning of the week, and even towards Friday, it brought up gold and a lot of other things. Then you had India and Mexico the week before. We're going to be getting the UK, Bank of England. They'll either be cutting rates or not. I don't know if we're going to hear from any other elections, but the fact of the matter is it's an election year for us. A lot of countries all around the world are doing the same thing, and the first step so far has only shown volatility. So that's the summary of all of it. We'll see how it plays out. But now coming into the next key, this is what I meant about the whole, it may be weird with how it plays out slow because the rate cut odds are still in question. Last week, especially after Powell, even though Fed and the dot plot said only one rate cut by the end of this year, the market and the Fed futures was still pricing in two. Now, we talked about this on Thursday and we were discussing because if you remember, remember, December till March, the market started pricing in 7 when the Fed was only pricing in 3 or 4. And then by March, the market got down to 2 rate cuts once again and then started moving. But the fact of the matter is, this can take a lot of time. It could level out in a couple of weeks. And what I mean by that, the Fed futures come in alignment with the Fed, or every little set of good data, it could make the Fed futures even bullish and price in more cuts. And then if we get bad data, that will start bringing it down to that equilibrium. But this is that push and pull we were talking about last week. And given that we're going to be getting some lower volume here into the summer, I would not be surprised if this has a big effect. But unfortunately, it moves slow, and it's going to be one day of responding, 2 step forwards, 1 step back, 2 step forward, 1 step back, until there's really a decisive change. So that's why we got to watch the data, watch the Fed speakers, and anything else in between. Those rate cut odds, I wouldn't forget about them completely, because how you've seen the bonds move and get that little rally recently, this is all playing into it. So that's the second key. Keep your eyes out for that. But now finally, get ready for summertime, baby. And what I mean by that is volume's going to be low. It was already low to begin with over the last couple weeks. We've been talking about liquidity and all of that, but you'll notice on some of these day-to-days and just random events overseas, we're getting big bursts of volume, and then it starts to level out again. So get used to it, because pretty much till like August or beginning of August, it's going to be this summertime environment. You got people taking their vacations, doing all of that, holidays. We're going to be having Juneteenth here this Wednesday. Couple weeks, you're going to be getting July 4th. And then the last holiday, Labor Day on September, that is pretty much going to mark the end of summer. So until then, I would be prepared for weird, slower moves. We might get more activity coming into July when all of the earnings start, but we're halfway done with this year. We're all still following a path, and now, before you know it, man, it is going to be third quarter. But this quarter right now, it's going to move a little bit slower, so I hope you're ready. But now, let us get into the plays. So, right off the bat, I have a couple of plays. We're going to talk about what I did with the trading account, but this will still make sense. But I'm not expecting much this week, and there is still a couple of plays that have been keeping my attention, and that is gold and oil. It's the same plays over the last 2 weeks. Some of you held them longer, some held oil longer, some of you are still in the gold like I am. It is the exact same logic for both of them. Gold is related to the global rate cuts and everything going on with that, and then oil is related to having one of the lowest risk premiums, especially related to gold. So it's the same exact logic. Last week on Monday or Friday, we saw gold move around a little bit, and it showed a lot of weakness up until Friday when some of the politics came in, and then it actually got a boost there. So watch out for both of these plays. I think these are going to be interesting during the summer, and especially as we wrap up the summer. Keep this in mind for a couple of months. We're really going to see their true color shine. Is that a pun? I don't know. We'll see. But that is play number 1. Watch out for that. Then play number 2, it's not so much the play as it is the industry and uranium. There's been a lot of things going back and forth. You could even tie it into oil and the commodities. We heard a little bit last week, and I think they actually just got a big downgrade after everybody was upgrading it. But it reminds me of oil and natural gas at those points where it's up a lot. It's starting to make moves, and people are saying, no, it has to die, or it's going to go parabolic again, and then it is related to a lot of the politics and certain things going around the world. So watch out for that. I have no plays on that. I'm not exposed. We did play CCJ earlier in this year, but for now, I have nothing. So I put uranium, but CCJ, that's Cameco, I think uranium, UUUU, and there's a couple of others. Nucor, I think they even had earnings on Friday too, so watch out for that. That is play number 2, and then finally, play number 3, baby, the banks. They were an underperformer the last couple of weeks. I'm sure some of you guys have noticed. We've watched even a lot of back and forth with bonds that even factored into some of the REITs, but the way I'm looking at it is it's underperforming, and right now we just got another dot plot, and there's still a little bit more shakiness. Even though banks do benefit from the higher rates, you got to start thinking, if the rate cuts do get pushed back, how will the banks take it? But even more so, how will their bonds take it? Because that means you may just get another year of longer held to maturity pain, even though we haven't reacted to it in a while. So putting it on the radar, keep your eyes out for it. We brought it up a couple of times here, but banks have been in an interesting space. There has been a couple of outperformers and value names like Citi, so we'll see where those go. But those are the main plays as far as everything else now. Some of you were there on Friday, some of you weren't, so I'm glad I have this video to talk about it, but I am clearing out my trading account. That TD, I got about like $93,000 in it. It was higher, then lower, then higher. And there's a lot of things reminding me of last year, but the way I'm looking at it, I'm doubling down on the long term. And the real motivation behind this is simply we are getting into a slower environment. I do a lot better on more global volatility stuff. Sometimes when it's slow, it could be death by 1,000 cuts, but really, I've been getting these questions a lot about what's going on, the economy, interest rates, the yield curve, and the way that I'm looking at it, I like a lot of what I said. And the fact of the matter is, until the threshold is met, I think we're going to kind of be in this weird environment where everyone's following the path, and that's why, like, good news, bad news, bad news, good news. A lot of the things are just going back and forth, and Wall Street has no shame in any of it. So the way I'm looking at it, I could get paid to wait a little bit. And here's the thing. I'm not going to, like, stop trading. If anything, I plan to focus on like 1 or 2 plays at a time, specifically futures. They're easier to get in and out of, and then you don't have to like hold them as long, and you could still make a decent amount. But I like the indexes. I like gold. I like oil, all of that stuff going on. But I just noticed too much temptation and too low liquidity. I just don't really want to participate until my yield curve uninverts. So that could happen in 2 weeks, or it could happen in 2 years. So be prepared for it. I'm going to get paid meanwhile through the yield. And why I'm telling you all this, because get ready, but you should assume that I am going to be getting out of everything. Does this apply to my long term? No. I'm going to hold the long term. I'm still going to add to the long term, and I still plan on buying plays for the long term. None of that changes, but the speculation, that is where I want to change it right there. So if anything, you should probably assume that I'm going to get rid of everything, and I'm probably going to hold on to that Intel swing that went wrong. I like Vanny for a biotech play in the long term, and then Baidu, that China play. Even though I've been early and now it went up and down and back down again on me, I am still going to be riding that one out, and maybe MPW. I have the long term, but I also have some of those flip shares. I'll see how that one plays out, but I think all of them except for Baidu still pay yield on there. So I'm telling you this so you have my plan, but like realistically, man, we keep talking about wait till the threshold, and I just think I should take my own advice with it when it's all said and done. And I think at the very least, even with some of the plays too, it'll help be a little bit more focused. So that being said, I hope you're ready for all of it. If you have any questions, let me know. I got rid of like 7 different names. We got out of Humana, MSOS. I even got out of my yen future and a lot of other ones. I think like I said, I have like Baidu, Vanny, MPW, and then like a couple of other smaller biotechs. I'm going to take my cash, get me a little bit of yield, and then if the right volatility situation matches up, I'm going to go for it. Otherwise, long-term, collect my yield, and then depending on what some of the gold and oil trades could make, I'm going to still grab a couple of those here and there, but I don't want to hold too much, and this time I'm actually going to stick to the cash, baby. It pays. It pays. So I hope that helps you out. Let me know if you have any questions, but also at the same time too, I hope it could be as an example. I hope I wasn't a bad example at other times, but when it's all said and done, if you really are looking for certain things and you are, again, like I was saying, death by 1,000 cuts, I do, again, long-term is killing it. Still, year after year, even last year, you know, I had the same thing during summer. I had a really, really bad NASDAQ short, if you guys remember. Last year was bad, but then that last, like, 2 weeks, 3 weeks, we made a lot of money after Powell did his pivot and all of that. So I don't want to put myself in that situation again where I have to like, oh, maybe hit a string of plays. But then too, I have been very focused on the yield curve, and I don't like what the market is giving me, especially as we're this high entering into the earnings, but it's not like I'm running away from the market. And this is what, you know, we keep talking about this. I'm waiting for a threshold to speculate, But meanwhile, I want to benefit off the melt up, and that means you get the damn long term. I am not backing down on any of that. I have my YouTube long terms. I have my other ones. So I hope you see where I'm at here. It's being more strategic, making sure our areas that win can keep us profitable. And at the same time, if there's a liability, I don't want to keep letting that one run there. So I hope you feel me on all of it. Let me know if you have any questions. And now I do have a question, actually. So a chat sent me an email, and they were asking me about the Greeks. They were like, do they matter? Do you use them? What should I learn about them? And they were wondering if I could make a video on it. So here's the deal. I have so many option tutorials on this channel. I don't know, some of you guys have playlists. Maybe we need to go and organize them, but there's a lot of old tutorials. I sound like this. Oh, yeah, options in the Greeks. But, you know, I sound a little younger. It's always a good time, but I think a lot of you guys learned some great things over the years. A lot of people have taken it, repackaged it, did their thing with it, but when it's all said and done, I have these videos, and you could go look back at them. I'm down to update them. If you want me to update the videos, y'all got to let me know. Y'all got to like the video. You got to tell me in the comments. But it's kind of contradicting because I don't really care, or what's contradicting is I don't care about the Greeks, but we talk about them and are aware of them almost every single day when we're going over options. Volatility, the dollar for dollar moves, those represent the Greeks. Vega is volatility. You see that little metric. If we go to an option chain, you'll see like an IV and volatility. Oh, that's a horn. But that is related. IV %, that's Vega. Delta is dollar for dollar. You know, we go even, I think, on the live streaming channel, the Josh Scholes model, how to find 1,000%ers, you know, it's based off of Delta and understanding how options out of the money versus in the money have a certain value that they move with the stock. And then once you're in the money, you get dollar for dollar. So that is Delta. So the point is, you should know what they are and how they operate, but the thing is, I would never really execute a strategy that is based solely on the Greeks. It's not like, oh, wow, this delta's here, and because of this, and then only go for plays with IV of this. It's just like open interest in volume. You should look at it, know what it means, take it into consideration, but there's no real like strategy derived from playing those when it's all said and done. I think a real like comprehension of options, like naturally understand it's a contract. You are making an agreement. Somebody is offering to give you something, why you pay the premium, the break evens, and understanding things. And like even when we go over earnings, when we do the pricing in, that is understanding some of the volatility and what people are expecting. So I think you should understand it. You could go check out any of the old videos. And once you do learn about it though, just make sure you don't like turn this into some weird strategy that you're going to be going after, just trying to chase down the Greeks to make a play. So let me know if you have any more questions or if you want an updated video. I got y'all. But now let's get into the lesson, baby. So today we are going to be talking about strategic trade theory. I'm telling you, if you guys weren't on the Thursday live stream, you should go back and watch it if you've been interested in the lessons, because when we're live and I have the live audience with y'all and we went over policy analysis and debate and a lot of other things, it's really fun. So I hope you guys aren't missing out on any of them, because there was some good lessons that we were going over as related to this chapter. So before I get into it, one, if I interrupt, that is my bias and all of that, and I hope you guys get it, but I am very proud of a majority of you guys so far. The discussion has been very good, even Thursday, and just, I don't know, man, it's kind of like, oh, happy Father's Day, man, because I'm just watching some of you guys start to grow in your critical thinking, and I commend those of you that have actually stuck to that and have been learning this in a way, and you're picking a view, you're understanding it enough to justify it, even the criticisms and all of it, man. It is very good to watch. So very proud of you guys. I'm glad my investment in this is paying off, and good job at keeping up. It's a lot of content. We've gone through all of it. I know when we're going over it every single day, it could be easy to get lost, but some of you have took it upon yourself to really take your notes, reread it, go with it. Remind me of my mom, man. I don't know if you know, my mom, she actually got a degree, you know, she became a nurse, and she did not really speak English that well in the beginning. She used to record all of our classes in English and then have to go home and replay and listen to it. I don't. Maybe I should have said a father story too, but he ain't do that. No, but when it's all said and done, though, like I'm saying, those of you keeping it up, taking it upon yourself to learn it and go through, man. This is how a college class would be. So good work. And now, let's get into the strategic trade theory, industrial policy, and high technology industries. This is going to be the segue into the strategic trade theory, but high technology industries have been one area in which governments in many advanced industrialized countries have relied heavily on industrial policies. Boosting the international competitiveness of such industries has been the principal goal of such policies. High-tech industries are highly valued for the contribution they make to national income. These industries tend to earn rents, that is, they earn a higher than normal return on investment, and they pay higher wages to workers than do standard manufacturing industries. In addition, relatively recent developments in economic theory that build upon the basic insight of the infant industry case for protection suggest that governments can use industrial policy to create internationally competitive domestic high technology industries. We examine these issues here, focusing first on the economic theories that justify the use of industrial policy in high-tech industries, and then examining two cases in which industrial policy appears to have enabled high-tech firms based in Japan and the EU to become internationally competitive at the apparent expense of high technology firms based in the United States. We conclude by returning to the current U.S.-EU dispute in commercial aircraft. So strategic trade theory. Strategic trade theory provides the theoretical justification for industrial policy in high-tech industries. Strategic trade theory expands on the basic insight of the infant industry case for protection. Like the infant industry case, strategic trade theory asserts that government intervention can help domestic firms achieve economies of scale and experience in order to become efficient and competitive in global markets, in contrast to the classic infant industry argument, which assumes that markets are perfectly competitive. Strategic trade theory asserts that many high-tech industries are characterized by oligopolistic competition, that is, they feature competition between only a few firms. The combination of economies of scale and experience on the one hand and the oligopolistic competition on the other creates a theoretical rationale for government intervention to raise national income. So, hopefully you remember the infant industry case for protection. Government subsidizes, steps in, makes it easy for a business to come in or manufacturing so that they could get big enough where it's cheap and easy for them to compete. It's pretty similar here, but it's saying, and it's focusing on certain industries here, but it's bringing up the fact that like high-tech industries and some industries, it's only dominated by a couple of people. So that is the justification to say, yeah, we should intervene because it's only controlled by 2 or 3 people. Like otherwise, there's no way anybody would be able to compete. So an oligopoly or an oligopoly is an industry dominated by a small number of firms. The world auto industry, for example, is dominated only by 8 firms. The world market for long-distance commercial aircraft is dominated by only 2 firms. Such industries are clearly different from, say, agriculture, in which thousands of farms produce for the world market. Economic dynamics in oligopolistic markets structures are quite different from the dynamics we see in perfectly competitive markets. The economic analysis of oligopolistic competition can be quite complex. However, a detailed analysis of such competition would take us away from our primary concern. Consequently, we will leave a detailed analysis of such competition on the side-by-side and simply state that firms operating in oligopolistic markets can earn excess returns, profits greater than could be earned in equally risky investments in other sectors of the economy. I'll show you the little chart here. Oh, wait, I don't even think it's the right one. This is going to be for another one, but essentially what he's saying, and if you don't know, like an oligopoly, that is like, this is economics. You probably learned this in Econ 101. Author, homie, he's trying to just focus more on the trade theory aspect of it. So we're going to come back to that one chart, but continuing, suppose an American firm dominates the world market for commercial aircraft. The United States captures the excess returns available in this industry. As a result, American workers employed in this industry, as well as the people who have invested their savings in this industry, earn higher incomes than they would earn in the next best use of their labor or savings. American national income is higher than it would have been otherwise. If a European firm dominates the world market market for commercial aircraft, Europe captures the excess return and enjoys the higher national income. And because the oligopolistic industry is one in which only a limited number of firms can operate, only a small number of countries can capture the available excess returns. It is certainly reasonable to suppose, therefore, that societies would compete over these industries. Strategic theory thus suggests that in some industries, global economic interaction gives rise to zero-sum competition over the excess returns available in oligopolistic high-tech industries. So if you don't know zero-sum, it means somebody wins, somebody has to lose. Literally, the stock market is zero-sum. You got to think about it. Every time you sell out NVIDIA for a gain, somebody buys it, they may end up losing, or somebody was already short on it. Think about an option. Somebody buys it, somebody sells it. It expires worthless. Somebody wins, somebody loses. That, in essence, is zero-sum. Continuing, who is likely to win this competition? In the absence of intervention by any government, the firm that is first to enter a particular industry will win. So in doing so, effectively deters entry by potential rivals. Thus, such industries offer a first mover advantage. The first mover advantage arises from economies of scale and experience. Suppose an American high-tech firm is the first to produce and market a product such as a commercial jet aircraft. Because achieving economies of scale and experience is central to the ability to produce commercial jets efficiently, the United States, by virtue of being first into the market, has a production cost advantage over rivals who want to enter the market at a later time. Consequently, a European firm that could be competitive once it achieved economies of scale and experience is deterred from entering the industry because the cost advantage enjoyed by the established American firms make it very difficult to sell enough aircraft to achieve those economies. After all, who will buy the new aircraft's higher cost output? Absent such sales, the new firm will never realize the economies of scale and experience essential to long-term success. The U.S. firm, therefore, consequently, the United States, will enjoy higher national income yielded by the excess returns in the commercial aircraft industry. Other countries are denied these excess returns. Even though they were able to achieve the necessary economies of scales and experience, they would be every bit as successful as the American first mover. So this is giving you an example, but it is trying to explain the first mover advantage. So you should be aware of this. This may even come up with some of your stock analysis. Go look at Tesla. They were the first mover. Go look at everybody who came afterwards. They were competing at different things. And it's just saying, yeah, you can be able to compete, but if someone goes first and then they are gaining economy of scale and experience and they have a year, 2 years, 3 years ahead of you, yeah, you could come and compete. But now, who is going to buy your product if it is by default going to be more expensive because you have not figured it out like the other person who was first to the party? So that's what it's explaining here. And surprisingly, this comes up a lot in economics, or especially nowadays, I feel like, with some stocks. But continuing along, government intervention may have a powerful effect on the willingness of a latecomer to enter the industry. That is, targeted government intervention may enable late entrants to successfully challenge first movers. By doing so, government intervention shifts the excess returns available in a particular industry from a foreign country to the national economy. The logic of this argument can be illustrated by using some fairly simple game theory. Let's assume that there are two firms, one American and one European, interacting in a high-tech industry, say commercial aircraft, which will support only one producer. Each firm has two strategies: to produce commercial aircraft or to not produce. The payoffs that each firm gains from the four possible outcomes are depicted in figure 5.1a. So that was this picture right here. There are two possible equilibrium outcomes in this game, one in which the American firm produces and the European firm does not. That is cell number 2. So Americans produce, European does not produce. You are right there. And the one in which European produces and the American firms do not. Cell number 4. You're just going to flip it around there. So thus, this particular high-tech industry will be based on the United States or in Europe, but never in both. Whichever country hosts the firm earns 100 units of income. Which country captures the industry depends on which firm is first to enter the market. Let's suppose the American firm is the first to enter the industry and has realized economies of scale and experience. In this case, the European firm has no incentive to enter the industry because by doing so, it would earn a profit of 25. If we assume that the European firm is the first to enter the market, then it realizes economy of scales and experience. In this case, the American firm has no incentive to enter the market. Thus, even though both firms could produce the product equally well, the firm that enters first dominates the industry. According to strategic trade theory, therefore, the firm that is first to enter a particular high-tech industry will hold a competitive advantage, and the country that is home to this firm will capture the rents available in this industry. Against the backdrop, we determine how governments can use industrial policy to help domestic high-tech firms. Government intervention can help new firms enter an established high-tech industry to challenge and eventually compete with established firms. Government assistance to these new firms can come up in many forms. Governments may provide financial assistance to help their new firms pay for the cost of research and development. Such subsidies help reduce the cost that the private firms must bear in the early stages of the product development, thereby reducing the upfront investment a firm must make to enter the industry. European government participating in the Airbus consortium, for example, have subsidized the development of Airbus aircraft. Governments may also guarantee a market for the early and more expensive version of the firm's products. Tariffs and quotas can be used to keep foreign goods out, and government purchasing decisions can favor domestic producers over imports. The Japanese government, for example, purchased most of its supercomputers from Japanese suppliers in the 1980s, even though supercomputers provided by the American firm Cray Industries were cheaper and performed at a higher level. The guaranteed market allows domestic firms to sell their high-cost output from early stages of production at high prices. The combination of financial support and guaranteed markets allows domestic firms to enter the market and move down the learning curve. Once the new firms have realized economies of scale, they can compete against established firms in international markets. So he's saying that, yeah, governments can give subsidies and tariffs, but I think this is, in my opinion, one of the biggest ones, and you still see it a lot, but it's like, hey, if you are first and it's hard to compete now and you have to deal with that whole game theory thing, and then it doesn't make sense for you to get in, what he's saying as one of these options is that the government can say, hey, we'll buy the first set of jets. Yeah, they're going to be more expensive. They may be a little bit worse, but if we give you money for the higher products, because think about it, nobody rationally would choose the higher priced, worse product. They're saying the government could be the buyer, and if the government steps in as a buyer there, that could help level out the playing field down the road. So we could see the effect of such policies, production decisions, by returning to our simple game 5.1b. Suppose that the American firm is the first to enter the dominant industry. Suppose now that the European government provides a subsidy of 10 units to the European firm. The subsidy changes the payoffs that the European firm receives if it produces. In contrast to the no subsidy case, the European firm now makes a profit of 5 units when it produces, even if the American firm stays in the market. The subsidy, therefore, makes it rational for European firms to start producing. Government support for domestic high-tech firms has a second consequence that stems from oligopolistic nature of high-tech industries. Because such industries support only a small number of firms at profitable levels of output, the entry of new firms into the sector must eventually cause the other firms to exit. Thus, government policies that promote the creation of successful industry in one country undermine the established industry in other countries. This outcome is also clear in our simple game. Once the European firm begins producing, the American firm earns a profit of 25. If it continues to produce and a profit of 0, if it continues to produce and a profit of 0, if it exits the industry. Exit, therefore, is the American firm's rational response to the entry of the European firm. Thus, the small 10-unit subsidy provided by the European government enables the European firm to eliminate the first mover advantage by the American firm, but ultimately drives the American firm out of the industry. As a consequence, Europeans' national income rises by 100 units. The 110 profit realized by the European firms minus the 10 subsidy from the European governments, whereas America's national income falls by 100 units. A small government subsidy has allowed Europe to increase its national income at the expense of the United States. So if you're not getting it here, it's simple. This is zero-sum game. So just how the subsidy can get rid of the first mover advantage, unfortunately, it ends up and leads at the cost of somebody else who was making that income. Continuing, strategic trade theory suggests, therefore, that the location of high technology industries has little to do with cross-national differences in factor endowments. It has a lot to do with market structure and the assumptions we make about how production costs may vary the quantity of output. This is a world in which the classical model of comparative advantage does not hold. International competitiveness in the pattern of international specialization correction in high tech are attributed as much to the timing of market entry as to the underlying factor endowments. This is wild if you think about it, because it's saying, this is kind of the new stuff you're dealing with, that high-tech industries and then the subsidies and oligopies, how it's playing out. It's not really about competitive advantage as much as it is how that economy, whether government support or not, is set up, and then are you the first mover or not in an industry that outpays anything that is more traditional on the manufacturing stuff. Hopefully, that's combining all of these paragraphs together. Hopefully you're getting that there. But continuing, is that it? Oh, no, that's it. Yeah, that's it. Oh, I thought we were going, well, yeah, well, we'll leave it there because I have one more lesson there. And again, you could kind of see the game there, the game theory chart that they're doing, the prisoner dilemma. But fact of the matter is, I hope you're tying this into the broader theory. If it's saying factor endowments don't matter and it's talking about what governments do in first mover and how things are different from the traditional view, remember, we are talking about the state-centered approach. One could even argue that maybe these changes occurred because as states started to step in, it started to take you a little bit away from that comparative or competitive advantage situation. So, Chad, I hope you enjoyed it. I hope I see you in the morning tomorrow. Happy Father's Day, but that is your watch list, ladies and gentlemen. Make sure you're healthy, ready to go. Make sure post your watch list. Make sure we see you there in the morning. I need the armor on. I need the helmet shining. And I need you to remember, always be humble and always accept the learning that life gives, my friend. Don't fight it too much. But Chad, I love you. God bless you all. Have a wonderful evening. Drink that water. Stay hydrated, healthy, all that good stuff. I'll see you in the AM and horn.